When I was in a business class, in one of my university classes, I took a lot of business classes on, in my program. And I remember a professor always hinting at this word synergy, this idea of 1 + 1 = 3. And that always kind of stuck with me as a math person, like 1 + 1 is 2, isn't it? But 1 + 1 is 3. And he was like, that's the definition of synergy. And I remember it was like on a test and it was like, you had to like answer like that equation, 1 + 1 equals, and it was like, if you didn't write 3 or more, then you got it wrong. And it was like this idea of like stuck with me, because I think that when we think secret sauces on our wealth building journey, we think about, how do I either get more for every single dollar I have, or save and spend, get more for less in a way. And I think we talk about tax savings, we talk about credits, we talk about, when you invest, you get more for, compounding effect. We talk about all of those secret sauces here in this episode. And today we're going to jam. We're going to jam even more in here, because we're going to talk about, the idea of the synergy, but really this, how do I get my $1 to earn more than $1? If I put my dollar to use, how can I get that same dollar to earn more just by putting it into a structure? We want to talk about that specifically. We want to relate that to the Smith maneuver. We've talked about the Smith maneuver on our podcast because it is an extremely important type of strategy and structure and mindset to go around. And we're going to talk about legacy. We're going to talk about all of these things, and at the personal side and the corporate side. So Kyle, a lot to talk about. We're going to jam it in. Let's go.
Yeah, I love it. I love it. And a great way to frame it here, because I think this is one of the key pieces. And it makes it complex. It makes this world complex. And it also answers the question that you might ask yourself when you listen to some of our episodes and you go down the rabbit hole, or if you're a business owner who's been in our masterclass that you can find over at CanadianWealthSecrets.com/masterclass. When people come back and it's like the light bulb goes off on some of these strategies, right? Whether it's the Smith maneuver or whether it's something else that we've been, working with clients on, they come back and often say, like, why isn't everyone doing this blank, whatever it is, whatever the strategy is? The reality is that there is thinking to be done. And I think, like you said, if you're going to do this synergy idea, if you're going to make 1 + 1 = more than 2, it's going to take some time and effort, right? Otherwise, as you had mentioned, it would be the same thing for everyone. Everyone would be doing the same thing. So what we're going to be talking about here is starting from square one. Now, we know our audience, we have a lot of folks out there that love the idea of the Smith maneuver. Now, I say that because even those people that are like, it makes perfect sense, it takes a long time for people to get those wheels turning. For those who have got the wheels turning, amazing, great job, awesome work. And ultimately, it's like once they figure out that they go, I had $1 that I wanted to put into investments anyway. And they take that dollar, and instead of sending it directly into the investment, they first send it to their mortgage on their primary residence, which is not tax deductible interest on that mortgage. And then it opens up available dollars inside a home equity line of credit, which they're then going to borrow in order to put into the very same investment. So, I already see like $3 floating around here. Like we started with one. We put that dollar over here. We borrowed another dollar because it's not the same dollar, right? It's like a bank is giving you this extra dollar to put into the same investment. You still end up with the very same investment that you had planned on, whether it's in the market, in real estate, in private investments, equities, whatever, totally up to you. But you now have created a tax deduction at a personal level. And that's a very valuable thing where people often get misunderstandings out there about Smith maneuver is they think that their mortgage is going to get paid down, like their debt is going to go down, when in reality, the debt stays exactly the same, right? You just now have created tax deductible debt, right? So $100 of debt a moment ago, I put $1 down. I now have $99 of debt against my home, and I have $1 of investment debt that I've now put into the market. Now, some people are going, ooh, that sounds scary. I thought we're not supposed to borrow when we invest. But remember, you already owed $100 on your home. You still owe $100 on your home. It's just that one part of that debt is now tax deductible, which is super helpful if you're earning income or if that investment you're making is going to create income now or down the road, right? That's the goal of the investment. So it's a really logical strategy for people to use. What we want to do here today is we want to talk about how we can use this same idea. We're going to start, as you mentioned, at a personal level, and we're going to work our way to how it's even more supercharged inside the corporate structure. But we're going to start at a personal level where we can take, this is a different dollar, because if we've already put it through Smith maneuver, you really get complex if you try to incorporate both, although we do have some clients that do. But if we take a different dollar and you plan on taking that dollar and you plan on putting it into an investment, we have another opportunity for you where you can do Smith maneuver like moves and get some other benefits here.
Yeah, for sure. So let's outline the specifics here. And the tool, if you've listened to many episodes before, you know the tool because we've talked about this benefit before. Is let's take that dollar instead of putting in, say, on our mortgage to create that deductible debt, or then borrow back on the home equity line of credit to create, say, deductible debt. If we're going to invest it, we're going to take that dollar and now we're going to say use that dollar to open up a whole life insurance policy. And that insurance policy will, have a cash value associated with it and a death benefit associated with it. And that's the special version of the whole life. So this isn't just a regular, whole life policy. It has to be specially created to have a high cash value so that you can maximize that dollar and put that dollar into the two uses, just like a Smith maneuver. So we want to say, open up the policy. As soon as we open up that policy, we've got now this cash value that is high, and we then can use that cash value. So let's take that dollar that we would have put in, say, an investment, and let's borrow, like we were going to do on the home equity line of credit idea, is we're going to borrow that dollar from the policy. So we're going to use a policy as collateral. We have a couple options we'll talk about there, but we could borrow that from, let's say, from the insurance company. We can get a policy loan, and we're going to borrow that dollar, and now we're going to put it in the same investment we were going to. But now we have basically that $1 is invested. So we did that anyway. So we took that same dollar, we invested it, but now we have a whole life insurance policy, almost practically for free.
Yeah, and I want to talk a little bit about the freeness here because, and we're going to use the $1 as sort of a base.
People are going to throw up a barrier, Kyle. You're like, wait a minute, how does that for free? It doesn't sound like for free.
Exactly, because you're going, well, wait a second, there's interest and so forth. So let's talk about this for a second. Let's assume it's $1. When I buy that policy, okay, and I put that dollar into that policy, we like to consider this policy like a pass-through structure because the goal here for us is that, I don't want to say it has to be all the dollars, by the way, but most of the dollars that we send through a policy have the goal of those dollars being reused, synergy, as you had mentioned, into other asset purchases. Now, for us, it's not always immediate because we look for real estate opportunities quite a bit, right? But for other people, it might be right into the market. It might be right into, private REIT. It's totally up to you. You get to decide. But when I take that dollar and I put it into the policy, here's the nuance that's really important to understand. When I do this for my home on the Smith maneuver, my home is going to be worth whatever it's worth, regardless of whether I'm here or not. And luckily, there is no capital gain on that home. Okay, so when I pass on, if I'm using the Smith maneuver on my primary residence, right, which is where people use the Smith maneuver, because there's no tax, capital gains tax on the growth of this property if I were to sell or if my estate were to sell. Now, there are other expenses, and we can consider that as well. But you're going to get to keep most of that value. The difference here is, like, we're going to take this dollar, we're going to put it into opening a policy which has a cash value, which has its value, that it's worth now, which may only be about, 75 cents or 80 cents in the very first year. Okay. So that's really something. And we'll talk about how we overcome that. So
it's not
challenge.
The same dollar.
So it's not the exact same dollar, and it's not worth exactly $1 right away. Really what that is it's the insurance company saying, listen, we want you to stick around here. Are you in or are you out? And if you're going to cancel the policy, they're only going to give you 75 cents or $1 back, right? So they're basically saying, listen, we're going to intentionally make this not as favorable for you in year one, because otherwise you might just cancel and ask us for the money back. But let's put this dollar in. And what you get out of that is not only cash value that we can then leverage for the investment, which we can then write off because I am borrowing against this particular asset in order to put into an investment with the intent to earn income from this thing.
So you got a write-off.
So now I get a tax write-off, just like the Smith maneuver, except the nuance is that there's also this added layer of this thing called the death benefit. And if you're a middle-aged, average Canadian, non-smoker, fairly healthy, we say fairly, just like standard rating, you're looking at about 15 times as much death benefit as the premium that you're putting in right away. Okay. And again, it's going to vary a little bit depending on age and so forth, but around 15. So I put $1 in, I get my cash value, which is going to be a little less than $1 right away. We'll talk about how we get around that so we get that full dollar back. But I have a death benefit worth about $15. And when I think about that for just a moment here, is what I get to still make my investment. And if I were to pass away in that moment, I set all this up and then moments later, I take my last breath, my estate gets to walk away with $15, one of which has been borrowed, which means they get $14, which is also tax-free. And they also get whatever that dollar was invested in, right? Probably hasn't had enough time to create a capital gain if it was moments after we made the investment. However, you get the idea here that basically what we're getting is the same interest write-off that the Smith maneuver can provide us when structured appropriately, right? So don't go just do this blindly. Don't just go to the corner, the insurance guy on the corner that usually sells auto insurance. That's not where you want to go to do this type of thing. But what you're getting is essentially free legacy planning. You're getting free death benefit, and you're still getting the investment that you were planning to do anyway. And we'll talk about some of these nuances and how we can maximize that dollar, because for some people, they say, well, if I can only invest 75 cents of that first dollar I put in there, now I got to do the math on it. I got to go well, if I, invest 75 cents instead of $1, how much better am I going to be if this investment does? We can do all of those things. But what we would suggest is that, hey, listen, if you're serious about doing something like this, we structure it so you can actually get the full dollar back right away. So you can do the process, and that each year, every single time I put dollars in, I get those same dollars back for investment. Plus, I get more and more death benefit on the other end. And as the amount of money that goes in and is borrowed out grows, that death benefit's still growing above it as well. And I know that I have this investment bucket over here, like I plan to do anyway. Plus, I've got this extra bucket of, we'll call it a legacy or estate maximization, that's also growing at the very same time. So I didn't have to decide how many of my dollars go into investing, how many go into legacy planning, and you get to both essentially have your cake and eat it too.
Now, you said there are ways to get that full dollar, because right now, if I want to do this in year one, because I know that, in a few years, that dollar I put in is going to be worth more than $1 when I pull it out. Okay. So that's going to come in a couple of years. But right away, if I put that dollar in generally that structure, like you said, is going to give me 75 cents, maybe 70 cents, maybe 80 cents that I can now invest. Okay. But that's because I'm going to use a policy loan, and the policy, the insurance company is going to say, look, we're going to give you up to this much in cash value to take as a loan. It's kind of like a HELOC. When you have a HELOC, it's like if I have a ton of HELOC room, I still can only take a certain percentage of the actual, value of the value of the house, or that current value of the house. So there's that side too. But what do I do to get the full dollar?
I love it. So if your policy has enough premium, which typically would mean enough cash value, right? Meaning it's large enough, then we would go to a third-party lender. Okay. And a lot of times this is just to the big bank. Like we go straight to the big bank. We work very closely with some of the big banks in Canada and we know their teams. These are typically like, not at the branch. We're not going to the branch person. We're typically going up the chain and we're working with those who deal with this type of lending strategy. And really, what we do is we come to them and we say, listen, if this policy is large enough that the bank sees it being a benefit to them. Remember, everyone's got to win here, right? Like people ask me like, well, doesn't the insurance company make a lot of money when this sort of thing happens? I'm like, yep, that's their business, right? Their business is to make money on these types of strategies and structures. So 100%, just like automakers do it as well. We still buy cars, even though they make a lot of money off of the vehicles. Same is true here. And the bank, there's no exception. The bank looks at it and goes, listen, John, your first policy that you put in force was similar to my first policy I put in force, right? It was probably, I don't know, something like 12,000 a year, something like that, a small policy. A bank's not going to be interested in lending against that asset at the very first year because it's so small. They're like, a credit card has a bigger credit amount than the cash value here, right? So the bank's like, no. But if the policy's large enough where the bank sees some benefit there, right? Now, every bank's a little bit different. We usually say like if there's a couple $100,000 in cash value, we can actually go to the bank and not only can we get 100% of cash value, but we also have different secondary lenders who are willing to do a top up so that you get 100% of your premium. And that's a really important thing because in year one, remember, your premium, that $1 is premium. Right. It goes into the policy. It is not worth $1 of cash value on day one of this policy. But basically what we're saying is we have lenders that are willing to lend against the full $1 because they know that this policy, as you continue to fund it, it will continue to grow. And within the first few years, usually by year 3 or 4, every dollar we now put into the policy actually turns into more than $1 of cash value, and it evens things out. And therefore, they say, like within the first few years, we are now back to essentially just 100% of cash value financing instead of in year one where it's 100% of premium financing.
Yeah. Now, I think people might be kind of like going, ooh, when you say we have, there are some lenders that will do that. Now people are like, okay, well, sure. Any lender will be able to lend based off, say, an asset. Yep. But then it's like, but what interest rate, right? Yeah. So it's like now I've got to worry about that. Like, are you talking about like, is my interest rate going to be astronomical?
That's a big word.
Yeah, and therefore it doesn't even matter anymore when I go to invest because how do I make sure that the arbitrage between my investment and this rate is actually a winner or a long-term winner? Like that might be worrisome to some folks.
Yeah, no, exactly. And I would say that when we're working with the banks and the lenders we work with, and this will change, right? So if you're listening to this 5 years from now, I don't know what is going to be offered at that point. Just like back when we were in COVID, I had no idea that COVID was going to offer us such low interest rates, right? So it could go up, it could go down. But typically what we see is that when the policy size is large enough that they're willing to lend at prime or better. Right. So the bigger the policy, the better the rate actually gets. Like a lot of people might be shocked by that, but you go, wait a second, you mean the more quote unquote debt I take on, the better the interest rate? And the reality is yes, because it's secured against a big bucket of cash. Right. And again, you're slightly underwater in year 1 and 2 because you're being 100% financed on premium. However, by year 3 and 4, it's like you're now back just to about 100% of cash value. And from there, it continues to go on each and every year from there. We're creating interest that is tax deductible because we are borrowing to invest. And you're getting the same asset growth that you were getting over here as well, with the nuance that the day that I move on, right, sometime in the future, I'm going to move on to the next world. And my loan balance is going to be equivalent to the cash value, except once I pass away, the cash value no longer exists Cash value is the value while I'm alive. And since that is no longer the case and will never be the case in the future, unless Elon Musk figures out a way to bring me back, there's no more cash value. It is a death benefit. And that death benefit will always be higher than the cash value up to age 100, where they are equivalent. So ultimately, at the end of the day, you will essentially be creating yourself a free death benefit. Now, it's going to be net of the loan payout, or the payoff, I should say. However, you have now free permanent insurance in your pocket to take care of your estate. And the entire time when you built that investment, which was probably for your retirement, you now have no worries spending that bucket down, because you know that there's this legacy bucket coming that did not restrict you from creating the assets you needed to create in order to sustain the cash flow and the lifestyle that you were trying to achieve.
So I'm gonna flip back to my 1 + 1 = 3 in synergy of like the secret sauce is in a way it's not that we're putting the same dollar to use and it grows over here once. It actually grows twice. Right? Because it's like, I'm going to take that dollar, I'm going to lend against it, and the arbitrage between my interest rate and my investment is going to grow. Like that is going to grow at that say arbitrage rate. But contractually, inside the policy's cash value will grow, and it cannot decrease. It cannot go backwards. So it will go up every single day, because it's a dividend paying whole life policy that we're using to use this tool. So that's going to go up. And then it goes up over here on this side. So you got two, like it's not only just two uses, it's two growths. And so you've got the
100%.
compounding effect that never gets interrupted on the policy, but then you also get, say, the compounding effect that happens over on the investment side. So, and then when you think about safety, if you compare that back to your Smith maneuver, is that because the value of the policy won't ever go back down, you can't say that about your home.
So I was going to say, I'm so happy you said it.
So and I think where people get scared about the Smith maneuver. So if like you've been like, the Smith maneuver makes so much logical sense, but emotionally it's hard because I'm now going to borrow against the value of my home to make my, my investments. And if say my investments are mediocre, you're still saying like, this is secured against my home's value. And what happens if my home's value goes down? Can I make sure that the value of say if ever I needed to figure out how to pay off my balances, my debts, it's like, well, my house was supposed to do that, but now maybe it can't.
Right.
And so that might scare some folks from the Smith maneuver. But in this case, it's not going to happen, right? Like the value of that's not going to decrease. So it's a safer move. And this is partly why you get the better interest rate from the lender, is because the lenders look at a whole life policy and go, I know I'm going to get paid out here at exactly I need, because this person is going to be here or they're not. And when they're not, I get paid out. And when they are, I get paid out. So this loan as a lender is like A+. So why wouldn't I give them a good rate on that particular asset?
100%. And, I wanted to speak to this as well, because not only about the house going down in value, but like you live there, like that's your primary residence. Right. So you live there and you're like, let's say, for example, let's pretend the market didn't go down, but something else in your life didn't go well. I always like to say, let's pretend Armageddon took place in your own life, right? You lost a job, you this, you that, whatever. Who knows what could happen in the future? Where the Smith maneuver becomes scary to people is that, first of all, you're leveraging against your home. Now, you already had a mortgage on it, and the idea was that now your mortgage amount's still the same. So you're not necessarily taking on any more risk, but that dollar went into an investment, and maybe the investment's up or down as well. So there's like volatility on both sides with the Smith maneuver that can play with people's minds. We know over the long run, like 20-year time span, 25-year time span, Smith maneuvers, you're going to be miles ahead. But what I can't tell you is how you're going to feel this year, next year, or the next couple of years because of market volatility. Whereas if you got into trouble with the Smith maneuver, it might mean, let's pretend the market didn't even go down from a home ownership perspective. So it's like, hey, my home is still has enough equity in it, but I can't afford the mortgage payments for whatever reason because I lost my job, you might still have to sell your home and then use some of the proceeds to pay off the mortgage or whatever you need to do in order to make that happen. And that's like very scary. Want to pause for a second. Let's pretend that instead, and I'm not suggesting we don't do Smith maneuver here, but I'm saying let's pretend for a second that instead we did this strategy with insurance. Here's what would happen if Armageddon took place in your life. We put $1 in. The dollar comes out to make the same investment that you would have done with the Smith maneuver. This happens for any number of years. Maybe it's 10 years from now. Who knows? Your cash value is worth $1 million, let's pretend. You have a loan that's worth $1 million, okay? And you have an investment bucket that hopefully is worth more than $1 million, right? Otherwise, probably not a great investment. So you've got these two growing buckets, but you do have one loan. And let's pretend Armageddon happened in your house, in your life, in your situation. And you're like, I can't do this anymore. And it's like, and I need to sort of like get out of this. I don't have to sell my home with this strategy. What I do is I have to cancel my policy. And when I cancel that policy, my cash value, which is worth $1 million, can be used to pay off that loan of $1 million. Now, what I can't tell you in this example is if there's any tax that will be applied. Because if your cash value was growing, which it was, only conservatively, there may be some tax on depending on the growth of the policy. Because now you've basically said, like, it's like taking your RSP and pulling the plug on it all at once, right?
That's what it is. It's we've been saving the tax because we know that you will be tax-free if you use the death benefit to pay off the loan. But if you're gonna use this vehicle as an actual investment, you're gonna pull, you're gonna actually
take on investment income, essentially.
Right, exactly.
Right?
You're gonna take value from this, which means you're interrupting the compounding effect.
Yeah.
Then you're going to be paying tax on the difference.
However, what we also have is this other investment bucket as well. So I want to just pause for a second. And let's say you got to this place and you're like, I got this $1 million loan against, the $1 million cash value, which means a net zero there. And again, there could be a little bit of tax here, but I also have this other investable bucket. As you had mentioned, there's like two growing buckets and there's only one bad bucket. There's only one debt bucket here. So the one bucket cancels out the other one. There may be a little bit of tax, which might mean you might have to take a little bit out of this investment in order to help you sustain things. But one thing that you didn't do was you didn't put yourself on the street. You didn't have to sell your primary residence, which might be, your lifelong, dream to live in that home or whatever it might be. It is a abstract bucket. It is a policy, and we are taking a policy alone against it to do exactly what we were doing with the Smith maneuver. But here's the optimal scenario is that we either offset the premium into that bucket after, I usually say a 10-year runway is a good number, but the longer you can go, the better. But if let's say I fund it for 10 years, I'm not going to be able to keep taking money out in order to invest it. I might just have my cash value maintaining the interest here, but my death benefit is still there and still growing. And if I hold that, asset until I move on to the next place, I know that death benefit is going to be larger than the cash value unless I die when I am exactly 100 years old. That's where they become equal. I will never be upside down with this strategy. All that I need to be doing is making sure that if I want to take on a strategy like this, what I get is an investment, the original investment, and a legacy plan at the very same time without having to restrict any of the dollars out of my investing bucket in order to do so.
Folks, part two of this episode is going to come out, and we're going to specifically talk about that structure, the Smith maneuver, but now inside your corporation, in your business. How can we use that same structure to create the same effect on basically getting a tax deduction for your investments against your business income. So we're going to talk about how to use that inside the business in part 2. So come on back for that. We'll be putting that out in the next episode. The other thing that you want as, say, maybe a takeaway or your next step is I want you to kind of go back in the catalog. We've got a number of episodes that have Smith maneuver in the title. Go back and look at those, listen to those Smith maneuver type episodes. Start thinking about whether the Smith maneuver makes sense for you, or maybe the whole life policy move makes sense for you, or maybe a combination of both, like Kyle said at the beginning of this episode. If you're a business owner, then we're going to encourage you. You can front run the next episode. You can get over to CanadianWealthSecrets.com/masterclass. In our masterclass, it's a course. It teaches you how to create this system inside your business. So essentially, you could generate cash, tax-free cash flow from your business. We're gonna talk about some of those structures in the next episode for the corporation side. So those are the two kind of call to actions at this point. Otherwise, we're going to see you in the next episode, folks.